there. My name is Stephen Hurd with Keller Williams Realty, and I'm here today with Mike Rich, CPA. How you doing, Mike?
Good. How are you? Thanks,
Good.
Steve, for having me.
Good. We're excited to have you. And the topic that we're going to be talking about today are the tax advantages of home ownership. So you hear a lot of people tell you that there are advantages of owning a home. There's tax advantages. There's lots of write-offs. But what does it really all mean? And so we're actually here today to answer that question with Mike and discuss actual real-life scenarios of clients he's had that have saved money on their taxes after owning a home. So first, we want to just talk a little bit about you, Mike. Tell us, how long have you been in the business, and what is it exactly you do as a CPA?
Thanks, Stephen, for asking. My company's Rich & Company. We're located in Orange, and we work with small business owners and individuals, helping them plan for and mitigate their tax liabilities. I've been in practice for about 8 years now, and we love what we do, love the people that we help.
Awesome, cool. So you guys you live in Laguna Niguel, right?
I do. I live in South County.
Awesome, yeah. But you help people all throughout Orange County, or? Awesome.
Yeah, there's really no limit. We're licensed. I can practice in all states, but Orange County is my hub.
Awesome. Okay, cool. So you've been doing it for about 7 or 8 years, and you've probably seen a lot of scenarios. And have you had a lot of people actually get advantages from, tax advantages from owning a home?
That's good. I've seen both sides to that. I've seen people sort of suffer through opportunities where they could have taken advantage of home ownership, and I've seen them make the conversion from being renters to homeowners. Now, while I would never recommend somebody to get into a home or a mortgage that they're not ready for, if the time and the appropriate loan comes along and the right deal makes sense, there's all the advantages and all the incentives in the world for that particular case.
Wow, okay, so you've kind of seen the good, bad, and the ugly.
I have, yeah.
You've seen the renter who said, man, I wish I would have bought, but then you've also seen the homeowner that said, man, this is really working out for my bank account.
Yeah. we literally just had I referred directly a client that's been in mine for 3 or 4 years now. They've been talking about it. The tax liability is $6,000, $7,000, $8,000 for the last several years, and they just got approved. And based on their last several years' returns and the mortgage interest and the property taxes that they're now going to get to deduct, they're going to save about $7,500 a year in tax liability alone.
Oh my gosh, so you're helping someone right now that's getting a $7,500 savings from owning a home.
Correct.
That's awesome, man. Well, that's cool and that's great and all, but you know how it is, right? I mean, everybody hears about how there's an advantage, but how does it really work? So what I want to talk to you about is the mortgage interest deduction. How does it work? What portion of your interest do you get to write off? How does that work?
That's a good question, and thanks for asking. And most people, I'm going to make this as simple as I can for you and for our listeners.
Sure.
The government will look at your income, typically your wages and your net business income. Okay, and then arriving at taxable income, they will let you either deduct. They're going to give you $6,300 in a standard deduction, or they're going to let you itemize your deductions. And when you get to itemize, you get to deduct things like mortgage interest, you get to deduct property taxes, which also come along with owning a home. But then you get to also deduct things like charitable contributions and certain medical expenses, state taxes, things. So there's a few other incentives as well. But you got to figure that for every tax deduction that you get, you're going to get about a 30% reduction in your actual tax.
Okay.
Everybody's a little bit different, but just know that about $1 in deduction gives you about a 30-cent tax.
Got it, okay. Yeah. 30-cent tax or 30-cent?
Tax reduction.
Tax reduction, okay. Awesome. So you can either file your taxes and you can get the standard $6,300 that the government gives you, or if you have more deductions than that, you can itemize, and then that's when you get to deduct mortgage interest and stuff like that.
Correct.
So why don't you explain to us, in a typical mortgage, we know that loans are amortized, right, over 30 years, with a majority of the interest being in the first 15 years of the loan.
That's correct.
So you have talk to us a little bit about that.
Let me give you an example on a loan, and then I can give you a specific example here.
Sure.
So let's say you were looking for a property and you needed to get funding or a loan of about $600,000, which is typical in Orange County. At a 4.25 interest rate, you're looking at a payment of about $3,000.
Okay.
Which is also typical of rent these days for 2-3 bedroom homes, right?
Yeah.
So the way loans work, the way the amortization schedules work, is the bank wants to get most of their interest up front. So you're going to pay out that $3,000 payment, you're going to pay about $2,000 a month in interest alone.
Oh, wow.
So that all gets deducted on the back end. So now you have $24,000 in deduction that you didn't have before, making the exact same payments. And you include into that approximately $5,000 or $6,000 in property tax. We're looking at a nearly $30,000 deduction that you didn't have before, making the same payments.
Oh my gosh.
Yeah.
So you're saying basically you can deduct the mortgage interest that you pay on your loan and your property taxes.
That's correct.
And the property taxes, is that every year or for the first year?
That's every single year.
Really?
Every single year.
So every year you get to own your home, you get to deduct your property taxes.
You get to deduct the property taxes.
That's
correct.
wonderful. So basically the way it works out is what you're saying is if someone has a $3,000 mortgage payment, more than likely $1,000 is going to be their principal balance and about $2,000 is going to be an interest on that loan.
On the payment, correct.
And each month they're going to get to have that interest. So about in 12 months, that's about $24,000 that they're spending just in interest.
Correct.
And the government says, hey, if you want to deduct that, go ahead.
Correct.
Wow.
The government incentivizes you. Again, if you've got the down payment and if you can afford to make the loan payment, then it makes sense. The government will incentivize you to own your home. They incentivize property in the United States. And the way the amortization schedules work is that most of your payment in the first half of the loan are going to be interest. And it'll amortize slowly and gradually down so that towards the end, most of your payment is principal.
Right.
The fact, though, is that most people end up statistically refinancing every 5 to 7 years. So that they're sort of turning and going through interest expense over and over and over again. That being said, that interest and the property tax provides a significant deduction on the back end that they wouldn't have had otherwise.
Wow.
You also you also get the benefit of owning the property. So now you have an asset that you're paying on, that you were making payments on somebody else's asset before, which is now going to be growing, call it 3 to maybe 4 or 5% in the long run. You now have an asset that you can borrow against, or borrow with, or negotiate with. There's also tax incentives when it comes to the sale of your property.
Really? Okay.
So that a husband and wife will get a $500,000 cumulative exclusion or exemption from the gain on the sale of your property. Let me give you an example. So if you and your wife bought your home for $650,000 and you ended up selling a number of years later for $850,000, a $200,000 gain on your property would be completely exempt from tax.
Really? So the government wouldn't come in and tax you on that even though you've essentially made income that year on your home?
Right, on the sale of your property, not a dime.
Wow, that's great. So I mean, you know, as Americans, right, there's so much discussion and controversy over taxes, but you're telling me that the government is actually incentivizing homeownership.
They do incentivize homeownership, yeah. And like I say, it's got to make sense. I've seen people get into loans that they couldn't afford, and they state their income that wasn't legitimate, but if everything makes sense, there's every incentive in the world to own your own home.
Right, if they can afford it, if it's financially responsible, they're going to be able to take that payment, then it could be a good idea for them.
Agreed.
That's awesome. Yeah. So just to kind of summarize the two things that we talked about here, you know, number one is the mortgage interest deduction. When you pay your mortgage each month, a certain percentage of that is going to be paid toward your principal balance, and then a certain percentage of it is going to be paid toward interest on your loan. And you can deduct all of the interest on that you pay, and when you go and you file your taxes, let's just give an example. If I made $100,000 this year, and I paid $30,000 in property taxes and mortgage interest combined, what's my new income according to the government?
It would be $70,000.
$70,000. So
in taxable income.
In taxable income.
Yeah.
So instead of getting taxed on $100,000, now I'm only being taxed on $70,000.
That's correct.
How much would that work out in terms of monthly savings?
Well, back to that 30% principle. Now, everybody's going to be a little bit different and fall in different tax brackets, but kind of across the board, to put an average number on it so we can all relate here, we're looking at about a 30% between federal and state tax that they're going to take out. So if you were to save $10,000, we'll be looking at a little over $3,000 in tax savings.
Okay.
So if we're looking at $30,000 savings, there'd be about a $10,000 federal and state tax savings.
Wow.
That being said, if you're able to take that $10,000 and put that into your monthly amount or calculate that into your monthly savings every single month, we'd be looking about just under $1,880 a month.
Wow.
Is you could effectively spend more than you're paying in rent right now, and you break out even at the end of the year.
Interesting.
It's powerful.
That is very powerful. So it turns out to about $880 a month in this scenario that the homeowner is saving versus the renter.
Correct. In that scenario, yeah.
That's crazy. Well, I appreciate you sharing that. And then the second thing that we talked about is the tax savings when you sell your home.
Mm-hmm.
So, you mentioned one person gets a $250,000 exclusion,
Correct.
and then two people, married people, if they've lived in the property for 2 years, get a $500,000 exclusion.
Correct. So 2 out of the last 5 years.
2 out of the last 5 years.
2 out of the last 5 years. So a husband and wife or a married couple will get a total exclusion of $500,000 gain excluded from tax. So when I say 2 out of the last 5, something neat that I happen to see as homeowners grow and their incomes grow and their assets grow, they tend to move out of their home into a new home, and they want to keep their old home and rent it out.
Mm-hmm.
So they effectively have 5 years from that point with which to sell, and they can still exempt $500,000 in gain from tax on the sale of that property.
So there's advantages to both buying, and then there's tax advantages to selling as well.
Yeah.
Gosh,
Yeah,
well,
it's beautiful.
Guys, we do this video because you don't hear a lot about the government wanting to help you out with your taxes. So when you have advantages like this for both buying and selling a home, you really should at least get educated so that you can look at all the options for yourself financially. So if you have any questions, Mike, what's the best way for them to reach you?
You can find me on my website at richcompanyinc.com, just like it sounds. Or you can feel free to give me a phone call at 949-777-6797. And I would be happy to look at your specific situation and determine the tax savings that we'd be able to incorporate throughout the year and whether or not it makes sense tax liability-wise on your situation.
Awesome. Well, Mike, thank you so much for coming today. We really appreciate having you here. If you guys have any questions, you can either contact Mike or I, and we're happy to help you out in this process. Thanks, and we'll talk to you soon.
Thanks. Bye-bye.